Let's have a conversation about how to build wealth fast. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you're to ask me. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about how to accumulate wealth. This is an important element. We all know that we need to spend less than we earn in order to create wealth. But how about something more specific? You have a lot of videos and articles on the internet talking about wealth accumulation. But today I want to have a conversation about how exactly do you create wealth? Exactly how much do you need to save? And at what rate do you need to compound it at in order to reach your goals? Here is a wealth matrix to help answer those questions. And this is courtesy of Lane Alden, a great woman, a great financial expert that we've been following for the last few years. And we're showing you right now on the screen here. She has provided this matrix, and it shows the wealth accumulation after 25 years, inflation adjusted. So you can see that in the columns you have the percentages, and on the rows you have the amounts that the monthly investment. So for example, if you invest $250 every month at 4%, after 25 years you have 88,000. And if you invest $3,500 every month at 4% for 25 years, you have 1.23 million. And everything shaded in green is sort of epitomizes that the goal has been reached. So you have made $1 million. And in her analysis, 1 million is the epitome, if you will, the threshold for wealth. It is very important to understand that this tells you that at the end of the day, building wealth, accumulating wealth after 25 years, 20 years, 15 years, regardless of what your time horizon is, wealth accumulation is a mathematical exercise. It is a mathematical enterprise. It's all about how much you're saving and the yield on that savings. In other words, it's all about how much money you have, the capital you have, and the return on investment on that capital. So let's have, and I wanted to put this because it demonstrates clearly that it's all about the time, the compounding magic, the compounding effect of money, and the return. How do you build wealth? So as the chart shows above, if you want to accumulate money, if you want to accumulate wealth, there are really only two things to get right. Two things. You need to increase the difference between your income and expenses. And you need to save that difference and grow it exponentially over time. That's it. You don't have to read all the gazillion books or watch the gazillion videos to understand how to build wealth. You need to increase the difference between your income and expenses. In other words, you need to have disposable income. And then you have to save that difference and grow it exponentially over time. So in today's video, I'm going to talk to you about how to increase your income and save more money, how to achieve a high growth rate on your savings, how to produce passive investment income forever, and I'm going to give you a few wealth building examples and things you can apply today to become wealthy fast. All right, let's talk about how to increase your income and save more. If you are, let's say you are worrying about whether your wealth is growing by 6% or 8% per year, it doesn't matter if you cannot make enough money to reliably save and invest each month. So your first one, there are only 3 ways you can increase your income and save more. Number 1, pick a high paying job. And if you want to have an idea of what I mean by high paying job, I'm talking about 6 digits. If you don't have a 6-digit salary, maybe get 80K to 90K, but you got to get close to 100K. The Bureau of Labor Statistics has a nice database of occupations that you can rank by median pay. So if you click on individual professions, for example, you get a detailed description of professions that really can help you earn more money. I'm talking here about physicians, lawyers, actuaries, nurse practitioners, engineers, managers, financiers, and other technical professions. So this is kind of important. So You have to understand that it goes both ways though. If you're being paid a lot, the professions that tend to pay a lot also tend to have with them an increased cost when it comes to tuition. But it is worth it in the long run. Education is worth it. So you have to pick a high paying job. Number two, you want to make money with side hustles. Let's say you're not lucky enough, or this is not something, I shouldn't be saying lucky because it's not right. This is a poor choice of word here. What I wanted to say is that let's say you did not go as far as becoming a lawyer or a doctor. That's okay. We have a lot of very smart individuals, very smart and brilliant people who have no they are very successful. For example, Bill Gates, right? So you can make money. You can still make money with side hustle. You can pursue your entrepreneurial aspirations. So if you're making 40K, if you're making 50K, there are other ways you can supplement your income so that you are increasing, because that's the bottom line. The bottom line here is to increase your income. And you can do a lot of stuff, online or offline. And when it comes to online side gigs, everything from freelance writing or editing to freelance web design or coding. You can do translation. You can help out as a virtual assistant. You can do coaching, consulting, tutoring, marketing, copywriting. You can also have some offline side gigs. You can work part-time as an adjunct professor at a local college, at a community college. You can become a part-time dance or a fitness or yoga instructor. You can do freelance property management or handyman fix-ups. It's all about finding what really works for you. It's all about matching your skill set, what you currently have, the knowledge you currently have, to the needs, to the market needs. I'm sure you have needs in the neighborhood, you have needs in your city, you have needs in your apartment complex. It's all about just figuring out what you currently own in terms of skills and what the market is looking for. You can even be a part-time freelance private chef if you have culinary skills. You can do tax preparation, bookkeeping, you can watch kids, you can sit pets, you can do tutoring, the whole 9 years. The choices are vast. You just got to write down your skills in one column and write down what the market is looking for in another column and match those. Some of those skills, some of those gigs you can jump into quickly, while others may need an investment of time and money for training and certification. But guess what? At the end of the day, it is worth it. If your goal is to increase your salary, to increase your income, it is worth it. So besides picking a high-paying job, making money with side hustles, you also can start a business full or part-time. It really depends. So the reason why I was talking to, the other day I was talking to a friend of mine, we were having a conversation about how Jeff Bezos right now is worth $200 billion. And I was just telling him that no human being will ever work in their life to make that much money. You can only make it through a business. In other words, you rely on the work of others to propel you to great and extraordinary wealth. And the reason that so many millionaires are business founders is that successful entrepreneurship satisfies both aspects of wealth building, right? So achieving a high income and achieving a high rate of return on your accumulated wealth. So a rather small percentage of people are going to start the next Facebook, but it doesn't need to be that glamorous. Honestly, all you have to do, again, going back to your skill set, if you know a trade like plumbing or construction, you can eventually start your own company, your own contracting company, and scale it up. So if you can provide a service like fitness instruction, consulting, marketing, and so forth, you could eventually open your own place, hire people, and increase the scale beyond your own reach. So if you coach something very well, you might be able to turn it into a digital course and sell it to more people. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're having a conversation today around how to build wealth fast. No BS here. We're just getting right into it. I was just talking to you earlier about making sure that you look at the two main elements of wealth accumulation: the disposable income, the amount of money you are investing, and the number two, the rate at which that income grows, the return on your investment, the return on capital. Now let's talk about how to achieve a high growth rate on your savings. So at first, I just spoke to you about how to achieve a high level of income, and I was just telling you that you need to either pick a high-paying job, make money with side gigs, or starting a business full-time or part-time. Let's now talk about how to achieve a high growth rate on your savings. So to invest money for high rates of return, you usually either need to take on increased risk, increased volatility, or decreased liquidity. Here is an overview on how to achieve your target rate of return. Usually you want to have a blend of several of these asset classes for optimal diversifications, right? So I'm talking about, let's say for instance, and when I'm talking about asset classes, I'm talking about things like stocks, bonds, mutual funds, ETFs, exchange traded funds. I'm talking about alternatives. I'm talking about treasuries, so U.S. government securities. I'm talking about the savings accounts, certificate of deposit, money market accounts, and so on and so forth. All right. So how can you produce less than 4% annually in return on your investments? You can buy treasuries, corporate bonds, municipal bonds, savings accounts. Those will help you. You are really safe if you want to get 0 to 4%. The good thing here is that the level of risks here is pretty low. So low returns, low risks. So if you're the kind of person who is more conservative on the risk spectrum, I would recommend that you go with the treasuries, the corporate bonds, municipal bonds, and savings accounts. By the way, folks, we're not giving advice on this show, investment advice. This show is more educational. We have done research, and we are just sharing with you the results of that research. Just want to clarify that. So if you want to produce on your invested capital less than 4% annually, go with those: treasuries, corporate bonds, municipal bonds, savings accounts. The interest rate for savings accounts, bonds, mortgage loans, and other types of debts are extrapolated from the federal funds rate. And this is a rate that banks can borrow at from each other overnight. So, and the thing here is, the reason why it's important is because treasuries, the interest rate on treasuries, corporate bonds, municipal bonds, and savings accounts is linked to the federal funds rate also. If you want to produce, let's say, a rate of return between 4 to 8% annually, you want to go for preferred stock. You want to do peer-to-peer lending, so P2P lending, and invest in index funds. Historically, it's kind of important to understand that bonds provided returns in this range, but that's not the case today because the rates are so low that right now, and we're not going to go back to that level for a long time. So if you want to have 4 to 8% annually, go for preferred stock, peer-to-peer lending, and index fund. If you want to generate 8 to 12% annually, you have to start investing in things like high yielding dividend stocks with reasonable payout ratios and long histories of consistent annual dividend growth, emerging markets and other international stocks or ETFs trading at low valuations, high quality real estate investment trust and master limited partnerships, investment strategies employing the use of cash secured puts and covered calls to give good returns even in overvalued markets, and certain alternative investments that offer decent returns in exchange for lower liquidity, like perhaps some of the private equity funds that you have out there. One thing I want to say here is that if you want to produce 8 to 12% annually, you have to understand that the level of risk goes up, which makes sense, right? Risk is correlated to return. So if you want higher return, if you want to be a little aggressive, then the volatility of the portfolio will be high. How do you produce a return on your capital ranging from 12 to 15% annually? So here, you got to really move on to the sophisticated investor category. And you got to reach out to private equity. You have to reach out to the top quartile private equity firms in the United States or globally. or you can even invest in direct real estate investing. In other words, you have to buy property. So private equity often provides returns in this range, in the 12 to 15% range, since private equity managers can actually change and improve the businesses they acquire, and they typically invest for years in order to achieve the transformations that they set out to accomplish. So if you, let's say if you already have several $1 million lying around, investing in a reputable private equity fund may be a viable move. In exchange for low liquidity, your returns may be pretty high. And if you want to produce more than 15% annually, again, remember folks, the higher the ROI you're looking for, the higher the risk. So if you want to produce 15% annually or more, 15% or more annually, you got to be a world-class investor. And the best way to do this, either you are a sophisticated hedge fund manager or sophisticated mutual fund manager, or you manage your own money, you are a swing trader or a day trader, you got to have a knack for investment to produce that kind of that kind of ROI on a consistent basis. All right, and you can either do that, or if you just need to start a successful business. So if you are able to start a business that is successful, you can achieve long-term, double-digit long-term returns. And I'm talking here about, and it doesn't matter, the industry doesn't matter. The probability that you'll be a world-class investor, remember, is extremely low, but your chance of being able to create a highly profitable small business is not too bad. Successful small and large businesses often achieve returns on equity that surpasses 15% per year. So for small and highly scalable businesses like software or services, return on equity, according to research, can exceed 30% or more in their early stages. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are still having a conversation here around how to build wealth fast. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you are aware whenever we drop a new show. And we drop this kind of shows, guess what? Every single day, rain or shine. And like this content, share, and comment below. How to produce investment income forever. So I've talked to you about when you want to build wealth fast, you want to think about the two elements, the level of income and the level of return. So the ROI, the return on investment should be high, and the income to invest should also be high. Now let's talk about how to produce investment income forever. So one way to figure out how much wealth you need to accumulate to reach your financial goals is to determine how much investment income you want it to provide you every year, right? You want to get some money from it. A rule of thumb is to withdraw no more than 4% per year if you want your portfolio to last forever. That's what research has suggests. Now, there is not such a thing as a perfect rule of thumb, but it's a good starting point. And here we're showing you right now on the screen a table that shows how much withdrawn investment income that different portfolio sizes can generate at different annual withdrawal rates. And this table comes from Lynn Alden. It's courtesy of Lynn Alden, and we really appreciate her expertise on it's very clear, and for us it's just great. It's clear and simple to understand. And what Miss Alden is showing here is that you can see on the row side, on the top, you have the percentage withdrawn annually for income and the portfolio total. So if you withdraw 3% or 4%, you are in the great zone. But if you are in the 5%, you are in the average zone. And if you are withdrawing 6% or 7%, then you're in the red zone. In other words, you are depleting your portfolio. The portfolio will not have enough asset to generate income for you to sustain you over time. So it is very important that if you are thinking about, if you want to rely on investment income to live, to go about your life, you need to have enough money in the portfolio so that your monetary needs on a monthly or yearly basis do not exceed 4 or 3% of the portfolio's balance. This is very important. So this is something that you have to think about in terms of producing investment income and withdrawing that income over time. So remember that in reality, your withdrawal rates depends on what rate of return your portfolio delivers, right? So let's say if you have a portfolio invested entirely in bonds and treasuries that provide you a rate of return of say 2.5% per year, and inflation is 2% per year, then of course you cannot withdraw 4% per year without reducing your capital. So the withdrawal rate must match the ROI your portfolio is generating, and the ROI your portfolio is generating has to match the asset classes, the underlying asset classes. Remember, if your goal is to generate say 15%, then you have an illiquid asset. In other words, if you give your money to a private equity firm, you can't have access to that for 2, 3, 4, 5 years, which means that you can't withdraw at all. So you got to balance that. You got to balance the need to achieve a higher ROI versus your need for liquidity. And now let's talk about how to build wealth fast, because this is an important element that we want to talk about here. How do you build wealth fast? Number one, now the hardest part, folks, about building wealth is just starting, because after that, guess what? It gets easier, and because you build and build on the initial momentum. At first, there is so much information to absorb and so many different routes you could go in. But here is a general order of what things to tackle first. Before we even talk about building wealth fast, there are a few things I really want you to really pay attention to, and those are critical. Number one, you want to pay off high interest debt now. I'm talking about credit card, unsecured loans, and basically anything over 6% per year. You got to pay down that now, because keeping some low interest debt like a mortgage or student debt can actually be a good thing, because it lets you save money in assets that produce a higher rate of return and start building wealth. But those other high interest debts need to go. So channel money aggressively into them until they're done. One thing you have to understand is that if you have high interest debt, you need to consider this as an emergency and work extra hours or do whatever it takes to fix that aspect of things ASAP. So pay off high interest debt now. Number two, establish an emergency fund for liquidity. This is something that a lot of experts advise people to do, and people talk about having a fund that is equivalent to 3 to 6 months worth of living expenses or salary. I would say you want to push that to 12 months, 12 to 18 months, because 3 to 6 months actually is nothing. It's stuff happens. Stuff happens to you. Somebody gets sick, or your car breaks down, or there's a death in the family, or a variety of other things. And you need to have the liquidity. And that liquidity, trust me, 3 months to 6 months is not going to be enough. Second, that's for the emergency fund. The third thing is you want to cut spendings on things that don't serve you. And I'm very serious here, because we used to buy a lot of stuff that sometimes, I mean, in my own family, we have people who just stuff in their closet and they never use it. When you have those discounts, those rebates, those sales, those Black Friday sales, quote unquote sales, and people sort of go and buy stuff they don't really need. You got to stop that. You got to stop impulsive purchasing. And what you want to do here is that you want to start actually saving money. So cut spendings on things that don't serve you. One other thing you need to do if you want to build wealth fast is to seek out higher income streams. And I've already talked about that earlier when I said you need to get a high paying job, but that's more than that. There's more than that. One thing you want to do here is that you want to focus hard on your career and earn a high income for your expertise. What I'm trying to say is you need to be, at a minimum, be promoted every 2 to 3 years. And by promotion, I'm not just talking about changing your title. I'm talking about changing your responsibilities, changing your salary level, not the salary itself, the salary category. It's different, because companies have a salary bands, and it's better to be in a higher salary band, even if you are at the lower end of that band. So it's very important. So you want to focus hard on your career to make that happen. You want to work a decent job and have a profitable side hustle as well. The side gig I'm talking about. You want to go full-on entrepreneur and start a bigger business. So the thing here is that if you want to build wealth fast in the long run, the great opportunity here is that you have the online machine, internet. The internet is a great way to sort of level, quote unquote, level the playing field, if you will. So you can maintain a normal 9 to 5 where you can go to work 9 to 5 and maintain that and gradually build something on the side. That's why it's called a side hustle. So you're able to grow it, and once you're ready, you can just scale it up, and then resign from your company. Either way, you got to find a way to bring more cash into your life, have more cash available for investment. And one thing that I also want to say here is that when it comes to building wealth fast, you need to invest money as soon as you get it. For each paycheck or each month, if you don't have regular paychecks, the first priority should be putting a lot of that money into investments before it becomes spendable. This is called paying yourself first. And I'm not talking about paying yourself first, meaning you just put the money in a savings account that pays you 0.0000000000001%. No, I'm talking about a bank account, not a bank account. I'm talking about an account. It could be a certificate of deposit. It could be a brokerage account. It could be a money market fund, something that pays you a lot more. So let's say if you have a 401k, I would suggest that you automatically put at least 5% of each paycheck into it. You want to max out a Roth IRA each year if applicable. You want to set it up for automatic withdrawals from your checking account if possible. You want to put additional money into your 401k or start putting cash into taxable accounts, taxable brokerage accounts, that is. By saving at least 20% or more of your income each year, you will begin aggressively compounding your wealth. And the great thing here is that you can actually even automate a lot of this, because you can nowadays we have apps, you have online tools that allow you to track your wealth. We just finished a show on personal finance software, and it's just amazing what tools such as Quicken or Mint or FYNB. I think that's the thing. Yeah, I think I'm blanking here on the name, but you have a lot of personal finance and personal budgeting tools out there that allow you to track your finances, and that's what you want to do. All right, folks. Thank you so much for listening to this conversation. I really appreciate it. I spoke to you about how to build wealth fast, and I will see you next time. But until then, remember, stay wealthy.